Hello and welcome to Connect, the weekly podcast of the California MBA featuring one-on-one interviews with movers and shakers in the mortgage industry. I'm Susan Milazzo, CEO of the California MBA, and very happy that you could join us today. Before I welcome today's guests, I'd like to thank our 2025 President's Council sponsors. And these are companies that provide a tremendous amount of financial support for the California MBA, in large part so that we can continue to be strong advocates for the real estate finance industry before the California State Legislature and our regulators. So please join me in thanking our 2025 President's Council sponsors. Those companies are AmeriHome, Consolidated Analytics, Funding Shield, Guild Mortgage, Rocket Mortgage, Wiener Brodsky Kiter, and Western Alliance Bank. Thank you all so much for your support this year. We greatly appreciate it. And that brings me to today's guest. I'm welcoming back Tom Davis, who's Chief Sales Officer at Deephaven. Tom, welcome.
Thank you, Susan. Thank you for having me today.
Always great to have you on. I know that you've been on Connect before, so I want to welcome you back. You had shared with us, we always kind of get started how you get our questions started, how people came into the industry, but you had shared that you had interest in the mortgage industry as a child, which is fairly unusual. But tell us about why you love it so much and what keeps you optimistic about this tumultuous industry at times.
Yeah. The first house my mom and dad bought, the next door neighbor was actually our realtor. And so Miss Helen was her name. So she's listening to this. Hi, Miss Helen. But anyways, she was a realtor and she sold multiple properties in our neighborhood. And I did some side work from her and learned about real estate at an early age, which was pretty cool. In high school, I was in or middle school, I had my math teacher was a financial advisor. And so I started investing in mutual funds in sixth grade. And then in high school, I got into a magnet program called the Academy of Finance and ultimately went on to college and studied finance and then ended up in mortgage out of college. So was lucky to have, people in my life that, kind of mentored me and, guided me along this path, in my career and super fortunate for that. And my mentors today that I work with and have helped me, in my career and guided me to, throughout my career.
Yeah, that's pretty incredible. I wish we had more of that. More people in the grade school and high school talking about really anything about managing finance. I think that's really positive.
Yeah, I live. Yeah, so I actually participate in a couple of college programs as well.
Good for you.
So where we talk about, just mortgage finance and at Deephaven we actually have a mentorship program. So I participate in that, and so it's always good to to participate and help guide folks in their careers and have an impact. So, we're big into that at Deephaven.
So speaking of the company, I know Deephaven offers HELOANs and HELOCs that allow for some alternative income options. You recently announced some product updates. HELOAN close-end second that now includes DSCR income for real estate investors. Why do you think this is a good time to innovate in the second mortgage and equity solution space?
So so we do have a full suite of second liens. We do have a HELOC that goes up to I believe $400,000. Loan amounts as low as $25,000, and then a closed-end seconds. We do have a full doc program, and we do have alternative income docs as well, such as bank statements, P&L. And then recently, as of yesterday, we just rolled out a DSCR second, so a full suite of second liens on our standard, closed-end second. We do go as loan amounts as high as $750,000, and this month will be an all-time record for us on our second lien production. It's taken some time to build it, but there's a ton of momentum behind it, and we're committed to this space. We're very bullish about the second lien space and that market because look, the Americans are sitting at a place today where we're at an all-time record high in equity as far as home equity. I think it's close to $33 trillion in equity. And I think tappable equity is like 17 to 20 trillion where, they could actually tap into that. And then you have auto loans are an all-time high. Credit card is an all-time high, both over $1 trillion. You do have the average age of a home in the United States is a little north of over 40 years. And so, and then the borrowers, right, over the last 5 years that purchased a home or refinanced their home, going back though before the last 2 years, they're locked into these lower note rates, and so there's been a ton of appreciation. So we're seeing or the opportunity in the market, and we're seeing it, excuse me, is people are going to consolidate their debt to improve their cash flow. They're going to consolidate their debt to do home renovations, and a little north of 50% of second liens that we're seeing today are actually for home renovations. That's the biggest pocket is home renovations.
Wow.
And the average, there's a misconception that these loans have a lower loan balance. From a HELOC standpoint, I think that national average maybe is like 90,000 in that range. While on the closed-end side, we're seeing close to $250,000 loan amounts. And for originators today in the marketplace, it's a huge opportunity because they could just pick up the phone and call all their clients that they've done a loan for over the last 10 years and say, hey, you have equity. Let's do you need to consolidate that? For the investors that also have lower note rates that have equity, hey, we have a product where you could cash out using the second lien to go buy another investment property. Why tap into that lower note rate on the first and give that up? It doesn't make economic sense. So the originators that adopt these products and embrace these products similar to non-QM, it just allows them to have more conversations with their borrowers and help them take on more of a financial advisory approach, understand what they're trying to do. And that they, once again, we're seeing borrowers tap into their equity and leverage it to consolidate and renovate and other things as well.
Yeah, like you say, if they're locked into the lower rates, they're sitting on all the equity. It's time for them to kind of tap into that to use things, for like home renovation. That makes a lot of sense. Who are the non-QM borrowers that are in most need of like the second lien and HELOC options?
Yeah, so I mean, what it comes down to is on the self-employment side, you have 19 million folks that are self-employed that own over 30 million businesses. So that's a sizable part of the market. There's more self-employed people than veterans in the United States. And the veteran program,
Wow.
the VA program, that's one of my favorite programs. So there's actually more self-employed people than veterans, right? So and many veterans are actually self-employed, right? So self-employed people, we're in tax season, right around the corner. That the CPAs are going to be very active, and they're going to be working with their self-employed customers. So that's the self-employed is a great place to start. Investors, there's over 19 million investment properties that account for over 45 million doors in the United States. So, and the majority of those investors are mom and pop investors. There's a misconception that the majority of investors are institutional, like these large mega kind of institutions, but it's really mom and pops that own 2, 3 kind of investment properties. Those are great opportunities. They want to buy more investment properties. Why not you leverage the equity in the investment property to cash out to go buy more investment properties? And last year, 28% of purchase transactions were actually investment properties. So that's almost a third of the market is investment transactions. And then there's a whole bunch of other I guess non-QM borrowers, just like there's agency borrowers in the United States, there's non-QM borrowers in every city, just like agency. There's high income, high net worth, there's investors, there's self-employed people in every city. There's 40% of our population was not born in the United States. That's like 14% of our population in the United States. So there's that. So there's a ton of opportunity, and that's why we remain bullish, not just on the second liens, but the non-QM space as well.
What are some of the growth opportunities for loan officers in the non-QM space?
So I'm huge believer in the second lien and bullish. We're seeing a lot of traction, a lot of people adopt that. Another space that I really see growth in is the RTL space, or also called the residential transition loan space. And that is designed or solely focuses on investors, like your developers, your builders, those folks. It's not for consumer, right? This is a business purpose. And so the reason why that's so important is because in the United States, there's a supply demand imbalance of, let's call it 4 to 5 million homes in the United States, right? Because we've had this massive migration, and then home builders haven't been able to keep up with the population
Right.
demand. We've had COVID event kind of hurt the supply chains. So how for over the next 10 years, right, we have to build an extra million two homes to actually meet the demand and meet that deficit over the next 10 years. And if you look at the top 30 or the top home builders, the large institutional mega home builders in the United States, the top 20 home builders account for 35% of the new construction, right? In the last year, 1 out of every 3 purchase transactions was new construction, which is a high, like a 15-year high.
Yeah, I
So
was going to say.
new construction is going to continue to be here because we have to build. And the only way that you can meet that demand is there's only 2 ways. Either you renovate an existing uninhabitable property, not just if it's, and you bring that property back into the housing stock, or you build, ground up, from the dirt, and you go up and you build new units. That's the only way you're going to bring homes into the market over the next 10 years. So I think, so having access to a renovation or fix and flip product, or having access to ground up construction is important, and then in a bridge loan is important as well. So we actually have access to those products through our sister company Anchor. And so what those products allow loan officers to do is be a part of the solution for housing over the next 10 years. But those products allow loan officers to work directly with the builder and help the builder get financing. And then once the builder gets financing on those deals, then when the home is done, right, the builder is going to need to sell that property or get rid of that property. And so they're going to sell it to a consumer or maybe an investor. So now that originator could have access to do the second loan, be the takeout for that. And it doesn't have to be non-QM, it could be agency. So
Right.
having financing programs that work directly with the builders, developers, that's a huge opportunity, because unlike a consumer that might buy a home every 5 years or move, the builders and developers that are moving the weight and are moving transactions in real estate, they do multiple deals a day, a year. Some do 100, 150, and having access to those products will allow originators to tap into the high growth areas of the market and areas that are doing multiple transactions. And so what's nice, even on the fix and flip, and when that property is done, we have a solution to be the takeout for that investor for a DSCR loan as well, that really really marries, and is a solution for the takeout loan of that fix and flip. So I think those are great products. Once again, if you're an originator today, and 35% of your production is not new construction, or 28% of your production is not investor transactions, these are solutions, or these are products that originators need to penetrate those markets. And the ones who focus on it, we're seeing their production really takes off in a major way if they focus and they build expertise around these products.
Yeah, that's very innovative. I like the working with the builder and then having the loan officer, help sell the house and get a mortgage on it once it's constructed too. That's
Yeah.
very
Yeah.
that's very innovative.
Yeah, and I would say the big builders, they could get financing from the street, Wall Street, right? Well, your regional and these smaller builders that build maybe 10 homes, it could be tract homes, spec homes, or maybe they build 50 homes a year. Just like any other business, builders, need access to the capital and cash flow, that just like any other business, cash flow could be a problem. So having access to these products allows that builder to build even more units. And so, you know, we saw Q1 of 2023, there were a couple regional banks that kind of failed, and some other banks have pulled back on these kind of products, these construction products. In the past, the banks were actually the solution for the construction financing for the builders. Now, there's alternative products in the marketplace that are really competitive, and these products allow originators to tap into builders in their local markets, where 2-3 years ago that was not the case. So that's it. There's a lot of upside there for those originators.
It's a lot of upside, definitely needed in California, right? Where we need to work on our housing supply for sure. Thank you for sharing all of that. Much appreciated. You know, Tom, Deephaven has been a longtime supporter, member, sponsor at Western Secondary Market Conference for the California MBA. We're very grateful for your support. Can you share with our listeners why you choose to support our organization?
Absolutely. So, look, you guys, the state of California and your group does a phenomenal job, very active on legislative front at the national level. Your market is the largest market in the United States when it comes to production. And, you know, we, from an employee point of view, we have employees that are there. And it's one of the most important markets in the state or in the country. So we're proud to be sponsors and supporters of the California MBA. You guys do a phenomenal job, and we would love to continue to support, you know, the cause.
Excellent. Thank you so much. We really appreciate it. And I will see you in August at Western Secondary if I don't see you before.
I'll see you as well. Thanks again for having me. I appreciate it. And as always, great to hear from you and see you as well.
Great. Thanks, Tom. And thanks to all of you for joining us today. To access any of our past episodes, you can follow us on our YouTube channel. We're also available on SoundCloud, Apple Podcast, and Spotify. That's it for this week, and we'll see you next time on Connect.